to the Monday Futures Market Outlook for August 1st, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot that 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. So long as the S&P 500 maintains itself above the 1200 level over this market correction, then we have to conclude at that moment that the market is positioned to actually have a strong year-end rally. We'll be watching that technical strength during these market pullbacks and consolidations. But if we have any breaks to new highs above that 1370, 1380 area, then we could actually see a year-end rally that goes to 1450 and 1500 on the upside. Just to make a few key market observations, the primary trend of the market remains bullish. We were looking for that second quarter market correction, but so far the price action actually has been very much in favor of the bulls. We'll see whether or not they can actually follow through with it on the second half of the year. The biggest variable in the third quarter will be the US dollar. If the US dollar breaks down again, will naturally lead to strength in commodity stocks and eventually some weakness in bonds. We're still not seeing that. Bonds just broke to a new highs, as we'll see in the later charts. And the US dollar still hasn't broken to lower lows. So there's a number of variables we're watching in there, but the way the US dollar plays out and whether it actually bullishly reacts to the resolution of the debt ceiling crisis or whether it continues to deteriorate will give us some valuable information for what will happen in this third to fourth quarter. When we look at the daily charts on that S&P 500 using that E-mini futures contract, we can see that last week brought that negative price action that even broke below the 1295, 1305 focal point. But with the debt resolution being around the corner, the markets bullishly jumped overnight and are holding at the 1300 level or higher. Really at this stage, if the markets can actually dig in and reverse off of this, there's room for the S&P 500 to return all the way to its previous highs. But before we start making that kind of a forecast, it'll be very crucial in the first few days of this week that the bulls dig in and actually don't let the market erase this strength that it showed over the weekend. If the old supports are held at the 1300 levels and subsequently the market strengthens, then we could look at the scenario of it going to new highs. Next year, when we take a look at that chart on the US dollar index futures, we can see as the US dollar continues to consolidate down along its lows right above the 73, 73.50 focal point on the downside. And the US dollar continues to show price action that looks very weak. If these support lines in any way over the next few weeks are given out on the downside, that would open the window for a move even down to not only 72 but also the 70-71 zone on the downside. In that environment, commodities should do relatively well. We're going to get some crucial information because there's certainly the possibility that the US dollar could strengthen after the debt ceiling issue is behind it. But a failure for it to rally on that would certainly bode very poorly. Next year, we're going to take a look at copper futures, which has strengthened all the way to its previous highs. After that reversal on the downside, with this bullish break, copper is now coming into some significant overhead resistance. But so long as it consolidates up here bullishly and all pullbacks are contained to 10-20 cents on the downside, then copper can continue to break out and target 480 to 5 on the upside. Next year, I want to take a look at gold futures, and gold continues to hold up very well, even in spite of it being off a little bit first thing this morning based on the debt resolution. Overall, so long as gold holds above the 1560 to 1580 levels on any pullbacks, then there's still room for gold to finish these moves up to 1650 and as high as 1750 on the upside. Next year, I want to take a look at crude oil, and crude has sort of broken this wedge on the downside and has brought some weakness into the oil markets. But overall, so long as crude oil does not make lower lows, this is just maybe a key retest to a good basing in crude oil before we could see a potential rally. If we see any breaks of the 95 level on the downside, it could open a window all the way down to 90, 92. But if the U.S. dollar weakness comes in and the market strengthen, crude oil may very well make an attempt at the 100 level. Treat the crude oil very suspect between the 95 to 100 level in terms of commitments to breakouts. We would need a legitimate move above 100 to become more bullish on crude, and a legitimate breakdown below 95 to become bearish. So treat crude oil very neutral. Finally, I want to look at the 30-year Treasury bonds, which use the news of the debt ceilings as a reason to break out from its 2-3 month ranges and actually bullishly break out on the upside up to the 128 handle at this stage. This 128 to 130 level is probably where the upside is going to be contained to over the next few weeks on these Treasury bonds, but there certainly is nothing immediately bearish about them. That was your Monday Futures Market Outlook. Thank you for joining me.